First of all, when people talk about this trade, often they lump value and cyclicals together. And it is true, a lot of cyclicals, energy, financials, they score high on value metrics. But the reality is there are a lot of cyclical companies that are high quality, they're not deep value, whether you're looking at the rails, manufacturing, specialty chemicals, even some of the tech space like semiconductors that we think look very good right now. The earnings are improving. They'll benefit from an improving economy. And you're not really bottom fishing in some of the more challenged parts of the market. So we like the cyclical trade, but with a quality bias.
Fair enough. And listen, I take your point. I mean, we're lumping a lot of things together here, but we're really kind of talking about is this pivot from pandemic plays to reopening ones. Which side of that would you fall on? I mean, it's a tricky one because just as everyone's getting excited about the reopening, we saw this huge outperformance by the reopening trade last week. Well, now you get this week, you get a lot worse news on the COVID front, and we're back to the olden days.
Kelly, you're exactly right. And I think Bob nailed it. I mean, this market is just whipsawing investors like we've never seen. You know, Bob highlighted the banks. It's a great example. The day after the election, the banks, particularly the regional banks, had one of the worst days on record. You fast forward 3 trading days till Monday, that's their best day on record. And again, as Bob pointed out, okay, they're struggling again. Partly it's about rates, but really it's about this question of, are we going to have a better economy in 2021 than we have today? I think the answer is yes. We're constructive on the amount of stimulus that's already in the system. We're constructive that there will be another package in 2021. Yes, the size is somewhat dependent upon the political configuration, but we will get more stimulus, and we're constructive on a vaccine. So again, I think there's nothing wrong with adding to cyclicals on weakness. But, and here's the key thing, there are parts of the cyclical space that were challenged before COVID hit. Energy, brick and mortar retails, department stores. And this is where I'd be a little bit more careful about bottom fishing, because even if the economy improves, many of the structural factors that were hurting this part of the market, they're not going away.
Shepard Smith here. Thanks for watching CNBC on YouTube.